Welcome and thank you for joining today's conference, Market Surveillance Committee meeting. Before we begin, please ensure you have opened the chat panel by using the associated icon located at the bottom of your screen. If you require technical assistance, please send a chat to the event producer. All audio lines have been muted until the Q&A portion of this call. We will give you instruction on how to ask a question at that time. With that, I'll turn the call over to Dr. Benjamin Hobbs, Chair of the Market Surveillance Committee. Please go ahead.
Mute. Muted, Ben.
Thank you. For some reason, I couldn't unmute. Hello, everybody.
Muted everyone when we join.
Good. Okay. Hello, everybody. Welcome to the meeting of the Market Surveillance Committee. Today, we're going to be considering our draft opinion on the EIM Energy Imbalance Market Resource Efficiency Evaluation enhancements. But before we get into that discussion, as usual, we're going to take public comments on any other issues that folks would like to raise. And then we'll have an announcement by Danny Johnson about the market notice that just went out, and then we'll have the discussion of the opinion. So Silas, who is the operator, could you check to see if there's anybody who would like to make a comment at this time from the phone lines?
Absolutely. If you would like to ask a question or make a comment, please press the raised hand icon on your screen to enter the question queue. For our phone-only line, you can dial #2 on your telephone keypad. Once again, on WebEx, clicking the raised hand icon located at the top right just above the chat panel will place you in the question queue. On our phone-only line, you can dial #2 on the telephone keypad. At this time, there are no questions or comments in the queue.
Okay, great. Before I hand this to Danny, I'd like to introduce who's around the virtual table here. From the MSC, we have members Scott Harvey, Jim Bushnell, and myself, Ben Hobbs. From the ISO staff, we have Danny Johnson, who you'll hear from in just a moment, Brad Cooper, Greg Cook, Guillermo Bautista Alderete, Shami Davis, James Lynn, James Friedrich, and Gabe Murtaugh. Is there anybody that I've missed? I think I've gotten everybody. So at this time, Danny, I'll hand this to you.
Thanks, Dr. Hobbs. So I just wanted to kind of make an announcement. The ISO put out a market notice fairly recently in the last couple hours that signifies our intent to not take this matter for approval through the October joint governance meeting. I think instead we are looking to defer this to the December meeting. This is following the feedback that we've heard from stakeholders, both in written comments to the draft final proposal, revised draft final proposal, the dialogue that occurred during the final proposal, as well as the comments in the draft tariff language, and finally some of the opinions that we're going to be discussing today that are offered by the MSC. We think, given all this input, it is prudent to take a step back and see if we are able to incorporate any of this input to make design changes that would still allow us to implement the RSEE Phase 2 enhancements prior to the summer of 2023, but potentially better address some of the outstanding issues that have been raised by stakeholders. So with that said, I look forward to today's discussion and kind of understanding the MSC's opinion on this matter and seeing how that may inform potential design modifications, which we would look to take to the December governance meeting. So back to you, Ben.
Okay, thank you, Danny. So our discussion of the draft opinion on Phase 2 of the EIM Resource Efficiency Evaluation enhancements is going to be led by Dr. Jim Bushnell. The discussion will be divided into two parts. The first part will address the hour-ahead scheduling process EIM issues that we deal with in Section 3 in terms of treatment of low-priority HASP imports and exports. And then, so Jim will summarize that, and there'll be the members of the MSC will discuss it, and then we'll open up the phone lines. And then we'll go to the second part of the discussion, which concerns energy assistance, in particular the RSE failure and energy assistance section, which is section 4 of the opinion, which again, Jim will summarize, we'll discuss, and then we'll open up the phone lines. So Jim, invite you to take the mic.
Right. Thanks, Ben. I think this is a first in MSC opinion history where there's actually changes that might happen after the opinion comes out, because we usually don't put it out this far away from what an eventual decision might be. I think the idea of trying to figure out if there are ways to see if there are improvements that could be made in the next couple months, I think is a good idea. Yeah, originally a punchline in the opinion we put out when we thought this was an October decision was that what's being proposed here is a move in the right direction, but that there's clearly more work to do. And I think as we will go through this discussion, some of it is pretty significant. And some of it, I think, I do have some hope could be maybe sorted out, at least technically, in the short term. It's more a matter of stakeholders kind of getting their heads around the implications and coming to some kind of agreement on what the format should be. And then other issues are probably longer term ones that we're just going to have to sort of see how other elements develop to try to really fully understand. Okay, so I had in my outline, as Ben said, we're going to talk about HASS, we're going to talk about energy assistance. I'm going to spend just a minute, and I set a timer here to try to limit myself on sort of high level why have an RSE, which is the section 2 in the opinion, I think. This has kind of gone in circles through this proceeding, both phase 1 and phase 2, and I do think it's evolved a little bit. We have new participants in EIM that weren't part of it when these sort of things were set. I think thinking even within the CAISO has evolved, as is mine. So here's my latest take on why we have an RSE, which I do think is logically consistent. It may not be what everybody agrees with. But the way I now think about why we have an RSE is the purpose is to make the BAAs who are participating in the EIM confident that the decision to participate in EIM will not cause scarcity in a neighboring BAA to spill over in an unwanted way into the BAA that's decided to join. And the key here is that spillover would happen as a consequence of joining the EIM. And it's a key distinction because scarcity could always spill over from one balancing area to another, either in a market way or a reliability way. But the key here is sort of what does the implication of participating in EIM do to those implications? In this sense, it's a substitute. The RSE is a substitute for shared resource adequacy planning, which my sense is there's absolutely no appetite for on a broad West-wide footprint. And so what's a reasonable substitute then? And it would be, okay, every BAA takes care of their own sort of resource adequacy balancing. And if there's a shortfall, they bear the consequences for perhaps inadequate planning or bad luck or whatever it may be. And that participating in EIM wouldn't hurt the other BAAs who have adequately resourced themselves in one way or the other. And the other key part there is it's unwanted spillovers because there could still be very economically efficient and very rewarding assistance provided from one BAA that has ample resources to another that is short. And so willing transactions, we want to encourage and enable as much as possible. So the key here is preventing the unwilling aspects of it. And then another thing that's sort of I've become more aware of over the course of this proceeding is that, while the EIM machine engine itself cannot force a BAA that's got enough resources to sort of deplete its resources to the degree of actually implementing scarcity or load shedding, even if it's joined up with a BAA that is short, it can cause BAAs to deplete their flexible capacity in ways that would leave them with very little margin for error. And the RSC is as much intended to sort of prevent that form of scarcity as it is sort of literal scarcity where, you know, you're in a market and you're forced to load shed because somebody you're sharing a pool with might not have enough resources. Okay, so to summarize, we want to kind of have a system in place that would prevent unwanted spillovers of scarcity from one BAA to another as a consequence of participating in EIM. And among other things, this should hopefully make participating in EIM more attractive to everyone. Now, with all that as background, an important point that I think has been lost or wasn't stressed during the proceeding is the fact that the vast majority of RSC failures seem to be happening when prices are quite low or are nowhere near scarcity levels, let's put it that way. And we got some stats from Guillermo's people that we cite in the paper. They gave us a couple graphics also that we didn't get a chance to get into the paper. Maybe we can introduce those in a stakeholder process. But basically, you know, the median prices during failures are below $100. The means are a little higher, but there's plenty of failures that are happening at prices below $100, some at negative prices, and the minority are happening at these extremely high prices that we would normally associate with scarcity conditions. So that says a lot of things. It says something about the accuracy of the test itself, that there's all these failures at low prices, and that maybe there's, you know, we don't quite know what's going on during high prices. So maybe there aren't enough failures during high prices, but certainly there seem to be a lot of failures during low prices. It says something about maybe the incentives of participants to bother to even pass the test when prices are low. Maybe they're just not that concerned with it. And it says something about the implications for failure of the test if, in fact, failures are happening the vast majority of the time when prices are low and we're nowhere near sort of a regional scarcity by most definitions of that. So that's kind of an overarching kind of fact that I think is important to keep in mind as we think through a lot of these things. All right, so I'll talk about HASP EIM here for 5 minutes, and then we can do a roundtable. The HASP issues are sort of wrapped up in the fact that HASP is run over multiple intervals. Advisory and binding, as is the RSE. And these multiple interval runs are overlapping with each other, at least to some degree. So there's kind of alternating between HASP and then RSE runs. Some advisory runs are then influencing the other. And this creates all sorts of issues, among which our HASP is because it's optimizing regional or bids in real time as well as these hour-ahead schedules. HASP is thinking ahead, if you will, to what EIM will likely do when it's determining what is an optimal hour-ahead rigid schedule. So there's several issues associated with this that I want to walk through, and I'm going to end with the one that's actually the subject of the proposal, but I want to hit two others that we discuss in the opinion that I think are important and weren't really at the central part of the CAISO's proposal. The first issue is because of this overlapping nature of when the schedules are determined and when the RSE is tested and when E-tags are issued as well, there is it's really complicated to think about what types of what is backing some of the base schedules that use imports as a basis for the resources for passing the RSE, what is backing those? And in our sense is that there are some things that are plans to buy from HASP that haven't yet been firmly established by the end because either HASP hasn't been finalized or there's other ways in which things just cannot be cross-checked. And so in a sense, there's more of an honor system than I had actually appreciated to this process, especially when it comes to base schedules that involve imports on an hourly basis beyond just HASP. HASP is part of it, but the HASP transactions appear to interact with other types of schedules that are kind of daisy chains of transactions together. And so that's a really important issue kind of beyond just the CAISO and HASP in terms of how do we kind of verify or what types of criterion do we want to apply for verifying these types of imports in base schedules. All right, the second issue, which we spent a lot of time on, has to do with the interaction with FlexiRamp and this idea of how it can deplete flexible capacity. Because the price of FlexiRamp is almost always low today, and there's lots of reasons for that we've discussed in the past, HASP can want to convert what appears to be cheap flexible capacity into rigid hourly schedules. And the RSE is, in a sense, could be a tool for pushing back against that. But there are other solutions that should work in tandem with that, including a better FlexiRamp price. We believe that operator load biasing might be part of that as well, load conformance. And all of these things are trying to push back against this, what might appear to be, oh, there's cheap flexible capacity, let's use that for hourly schedules, which is in fact turning flexible capacity that we need for its flexibility into just kind of boring old generic energy that we should not be devoting our flexible capacity to. And this is an underlying issue that goes beyond just the RSE, but it's one that we kind of want to highlight, and it definitely interacts with it. Okay, so the third issue, the one that is the focus of the proposal, is, as Ben said, this idea that, well, HASP exports that are scheduled out of the CAISO in HASP are treated as, under the current system, are treated as obligations, load, if you will, that the CAISO needs to have capacity to match. But those HASP transactions, because HASP is looking ahead to EIM, probably are, at least some of them, backed by expected EIM imports. And so the HASP and the CAISO are caught in this kind of gray area of where EIM starts and where hour ahead ends in terms of what gets to count as supply or demand in the RSE and what is, part of the EIM and shouldn't count, should be done only after the RSE is passed. The proposal would, and we agree with this, allow the CAISO to not have to count its HASP exports, exports that are scheduled as a result of HASP in the HASP only, to count as an RSE obligation. We think that is appropriate. There is, a more controversial aspect in our minds about exactly what the receiving end of those HASP transactions, what the treatment should be for them. There are arguments that there isn't enough time to adjust, that most of the time these things are quite reliable. Both these things are true. And so we were supportive of what the current plan was, which was to just treat HASP, exports that clear HASP as part of a base schedule if you're importing them. But we do recognize that there is kind of a disconnect there, that if the CAISO doesn't have to treat them as load and the receiving end gets to treat them as supply, that is a disconnect. Most of the time it's harmless, but we get back to, well, most of the time the RSE is being failed when there isn't really scarcity. But when there is really scarcity and the prospect of a HASP transaction that is a low priority transaction could actually be curtailed, then it is more problematic to think of it as actual supply. And so this is a theme we'll come back to. We would probably want to be able to better differentiate a condition when the RSE fails and we don't have some kind of system scarcity threatening or looming, and situations where we do think it's much more likely that scarcity is going to be a real serious concern. That's going to affect our views about how the energy assistance penalty should be applied. It's also maybe an idea for this LPT transaction aspect as well. But I think there's a higher level issue, which is the first point I brought up, which is we don't actually know a lot of what parts of HASP transactions are actually going into base schedules already. And it's not clear, at least to us or to me, exactly what kind of process is being done to sort of confirm or verify or even could be possible in that process. And I think that's also part of this issue of how HASP transactions could be used, both the ones that are actually confirmed coming out of HASP, but even ones that are sort of speculated to maybe be likely to be coming out of HASP. So I'll stop there and let the others sort of pick up what I've missed and we can discuss.
Thanks so much, Jim. I don't have anything to add to very nice, high level, you have thorough summary. Scott, is there anything you'd like to add?
Nothing to add. Nope. I'll wait for comments.
Okay. So Silas, at this point, we can invite folks who are on the phone line to join us just to get in queue, and looking forward to your comments.
Great. As we move into Q&A, just a reminder that for the WebEx participants, you can please press the raised hand icon on your screen to enter the question queue. The raised hand icon is located to the top right above the chat panel. For our phone-only participants, you can dial #2 on your telephone keypad to place yourself into the question queue. Once again, WebEx participants, click the raised hand icon located to the top right above the chat panel. Phone-only participants, #2 will place you in the chat queue and indicate that you wish to ask a question. There are no questions in the queue at this time.
Okay, thank you, Silas. This won't be the last chance. So if it turns out that somebody in the audience would like to make a comment on the HASP-IM issues that Jim just discussed, then you can do so after, in the discussion that follows Jim's summary of the second half of the opinion. So Jim, hand it to you to talk about RSC failure and energy assistance.
Okay, so we'll see if I can do a better job of stimulating discussion here. I think this is something people have focused a bit more on, and certainly I think is more of the focus of some of CAISO's thinking in terms of what it might try to do in the next couple months. All right, so part 2 here is what I will just call the RSE failure consequences. Its name has sort of changed a couple times, but it is in essence an attempt to move from the current system, whereby if you fail the RSE, the penalty is that your imports through EIM are capped at a historic level that is the level of the last time you successfully passed the RSE. And I believe the spirit behind this is sort of like, okay, well, the system was operating okay when you were drawing 500 megawatts, and now you failed, and so we don't want to let you draw any more, because then, again, the spillover of scarcity might be caused. And so I think the idea there was we'll just cut off flows or cap them to try to limit the risk of this spillover of scarcity. With that kind of in mind, though, in a vacuum, this historic level is kind of arbitrary. It could be that, last time you passed, you had a lot or maybe a little, and it may have nothing to do with the conditions right now when you fail. And so it's kind of a crapshoot in that sense. But it's actually worse than that. It's not just in a vacuum. What's happening, and again, this is sort of something I've come to internalize better in recent months in this process, is that both, I realize that market participants have sort of an incentive to try to bump up their imports if they know that a failure is looming. You could do that kind of manually, but also there's an automatic process just within the market engines themselves, which are multi-interval optimizations. And what they're trying to do is minimize the cost of serving everyone as a function of the constraints the market is presented with. And if one of those constraints is we're going to cap imports down the road in interval 5, but we're going to cap them as a function of whatever imports were in interval 2, then it could very well be that the market engine could see, oh, well, actually, we can get more power flowing in interval 5 if we just buy more power in interval 2. And it might not make sense in interval 2, but it makes sense only because it buys you more imports later down the road. And that's just optimization doing its thing. Usually it's a good thing, but in this case, it clearly works against the spirit of what the RSE penalty was intended to do, which was kind of limit the amount that can flow during failures, not goose up the amounts that are flowing during other periods, especially if it's uneconomic to do so. So this whole thing is, really flawed. We don't know how serious that automated consequence is, but just in terms of conceptually, it's somewhat disturbing. And that's sort of underlines why it would be really helpful to move as many people, as many BAAs as possible to something else. And I think that was kind of the spirit behind the energy assistance idea, which is moving from this cap, especially a cap that's endogenously determined, to a price penalty associated with imports during RSC failures instead. And I believe there was widespread sort of appeal to that transition. Where things kind of became more problematic was trying to work out the details there. So the current proposal has $1,000 per megawatt hour or 2,000 under some conditions. I'm going to use the 1,000 just as an example. So it's got this penalty essentially at the bid cap that would kick in when RSC failures happen. It would apply to every megawatt of EIM imports whenever an RSC failure would happen, for BAAs who elect to be under this paradigm for penalties. Now, one of the things we highlight, and going back to what I said earlier, most of the RSC failures are happening when prices are below $100. And so if you're going to have a $1,000 penalty on trade when prices differ by $10 or something like that between regions, you're probably just going to kill off all trade. I think there's additionally concern by some stakeholders that this penalty would spike energy prices as well during periods when they shouldn't be raised to scarcity levels. Maybe that's possible, maybe for CAISO if there's a big enough thing, but my sense is the bigger risk there is that there just would be no EIM transaction. And the energy price in the receiving BAA would not rise to these penalty levels if there's no EIM imports at all. But that's also not efficient. EIM is meant to take advantage of these cost diversities and flexibility diversities. And if we're basically placing a $1,000 tax on all the trade, that's going to discourage a whole lot of trade. And most of the time, that seems to be, a penalty that's just too high for the conditions. Our sense is, most BAAs would probably stick with the current paradigm of the historic cap being set rather than move on to this option. There is in the proposal the ability to move back and forth between the current status quo penalty regime and this new sort of extremely high pricing penalty regime. So some may kick into the high penalty regime only when like scarcity is looming during a heat wave or something like that. That's better than nothing, but it could definitely leave us in circumstances where people are on the wrong type of penalty system at the wrong time. So either prices are low and they're on the $1,000 penalty regime and we just aren't having any trade, or they are afraid of the $1,000 penalty and so they stick with the current system, which with all the problems that the current system involves. So what we proposed is an alternative, and there's actually different flavors of these. I'll walk through them starting with our preferred, and then there's variants you could apply as well. So our preferred approach would be to somehow, and there are many ways to do this, link the magnitude of this penalty that would be associated with our imports during RSC failure intervals, link the magnitude of that penalty to some exogenous measure of scarcity in the region. And there's different ideas for doing this. The key, though, is it wouldn't be part of the same multi-interval optimization that's implementing the penalty, or else you sort of get into the same problem that I was describing earlier. So what I mean by exogenous is not that, Ben makes up a number. It's that the market has found some number, in a period sufficiently ahead of time that it's not interacting with the implementation of the RSC penalty as well. So a simple version we float in the opinion is maybe you just have 3 different thresholds. One in which prices are, below zero, in which case you clearly don't want to penalize, trade out. And another where prices might be below, say, $100. Again, this is stakeholders to decide these thresholds. And another where maybe 500 is the threshold where you start saying we're getting close to scarcity. And that would trigger different penalty levels, like 0 if prices are 0. We don't want to penalize trade if some regions have negative prices. or in 10 or something like that if prices are in the moderate range. And then you have the $1,000 penalty reserved for periods in which the scarcity indicator, if you will, is saying, yes, we are truly approaching a scarcity condition. That really large penalty would be reserved for those periods. If we're able to do this in a way, we're never going to have everybody be happy with everything, but if we can do this in a way that makes most BAAs comfortable that it's not a punitive penalty during normal times, then hopefully everyone will be more comfortable moving to a pricing regime like this and off of the currently flawed endogenous cap regime that we have now. Other variants that we discuss in the opinion involve some level of no penalty EIM flows. So, for example, you could maybe get your first 100 megawatts at no penalty, and only the next, everything after that is when the penalty might apply. Exactly what that, free band should be is another sort of design parameter. I guess I don't see a strong and economic logic to that, but I do see that it could be appealing. And if it's a way to get more BAAs into a pricing regime, I think it could be worth it. Another would be linking the scale of the penalty to the severity of the RSE failure. So if there is a way to sort of treat a very small failure that's maybe more likely to be a false positive with a smaller penalty or no penalty, then that would be another sort of variant or feature you could add. And none of these seem to be mutually exclusive to each other in principle. Being able to implement them technically is another question. Our sense is that if we could come up with an exogenous measure of scarcity, that it shouldn't be technically challenging to implement, because the current plan is already taking a number, 1,000, and just using it. There are some other issues that have to be worked through about how that interacts with Hass pricing and so forth. But I think those issues are at least mitigated if the penalty is much less severe most of the time. So I will stop there, and we can sort of talk through these options as well.
Okay, thank you, Jim. So there's actually a lot of information there. The idea of conditioning the penalty on 3 different dimensions, what the energy market price was, what was the degree of the RSE failure, and perhaps on the size of the transfer, that could be complicated, but I think would be result in penalties that are more appropriate for the situation. I don't have any more comments, Scott.
The only thing I'd like to do is thank Werman and his team again, as Jim did, that it was really eye-opening to get the actual data. We'd been reading between the lines of some other studies that CAISO did and had a feeling that there might be something like this going on, which, underlay some of our earlier opinions, but it was really very valuable to see the actual numbers that Werman's team put together.
Yeah, and I do think it'd be helpful to get those out to the stakeholders. We're still kind of trying to process them ourselves. So.
Okay. Thanks, Scott. Thanks, Jim. So Silas, we're ready to go to the phone lines, and so can you invite people to queue up?
Absolutely. So just as a reminder to all of our participants, in WebEx, if you press the raised hand icon on your screen, it will enter you in the question queue. That raised hand icon is located to the top right, just above the chat panel. To our phone-only participants, please dial #2 on your telephone keypad to enter the question queue and indicate that you wish to ask a question. Once again, for WebEx participants, that's the raised hand icon above the chat panel, and for phone-only participants, that is #2 on your telephone keypad. There are currently, one hand just went up. Caller, your line is unmuted. You can go ahead.
This is Robert Fisher with NVE. Good afternoon, MSC and CAISO employees. I would like to discuss just something brief in regards to the draft final proposal. It was my understanding that the emergency energy cost would be incremental to the transfer that was determined by the RSC. There's been lots of different types of verbiage used around this, and I think there is some confusion, and I'd like to discuss that and make some clarification, because I think that's an important decision point, because this emergency energy is incremental to the energy that you've already participated in the market. You've shown that you have capacity to. So making all the import prices have a large penalty at that point seems to be an incorrect direction. So could you please clarify that point?
Well, I'll let Danny confirm this, but our understanding is, yes, that under the energy assistance option, that the very first megawatt of EIM transfers would include this penalty price. And I believe what you're talking about is, although I could be misconstruing it, but I believe what you're describing is sort of another option in which we have this previous, amount of imports that you were allowed but would have been capped. And in principle, you could have the penalty applied only to the imports above that capped level. And there are technical reasons why that's extremely problematic, that we kind of thought about that for a while too, but the same endogeneity of setting the level of your cap would kind of, I believe, be turbocharged by then including a $1,000 penalty also in determining the level at which your cap is being set as well in this multi-interval optimization issue. So we can discuss kind of the framing, but I believe in terms of the actual proposal, it would in fact penalize every megawatt if you fail. Now, if you don't fail, there's no penalty.
Yeah, Jim, right, I can confirm that, and the thinking on this was if you add a $1,000 transfer cost to the failed BAA's import transfers, that it should dispatch all of the internal resources internal to that BAA, and there may be some kind of ramping constraints going on throughout the multi-interval optimization, but the resulting EIM transfer should be what is needed to actually make that BAA whole. There shouldn't be any economic displacement occurring because the transfer costs would be more expensive than internal resources inside that BAA.
Scott, this is Scott, but I think, this, one of the issues that concerned us was everybody is opting out of this. And I think it's because of this dichotomy that under the status quo, you can lean on the system and get the free imports up to the cap. But if you choose the assistance energy, it's good when you're over the cap. But if you're under that cap, then you're paying $1,000 for what would have been free. And I think that, created a lot of choices, hard choices. And as Jim said at the beginning, created the potential for people to make the wrong choice in the wrong time. And, that's a difficult issue to resolve, but that does seem to be part and parcel of why doesn't look like many people are going to choose this.
Yeah, and I've been following this, we had part of the initial proposal in regards to this, and the proposal was always an incremental amount from what you had in the failed test results. So if your import level, just to make sure we're all on the same page, if your import level when you failed the test was 100 megawatts, that 101th megawatt would be $1,000. Anything below it would be based upon the economics of that capped limit at 100 megawatts imports. I completely think it's a wrong direction if we were going to make that 100 megawatts that it would have already been there for free at a higher price level, because that is not the intent of incremental emergency energy. That energy is energy that we've already procured for in the previous hour or previous interval. So I don't think that's the right direction, and I would agree that this is the wrong position and why people are probably opting out. Yeah, Robert, I think I would disagree with that position real quick, Ben. The idea one of the things we've heard from the MSC is the market interaction of driving those transfers prior to the failed interval isn't good, and I think we were trying to get out of that paradigm by not having a certain subset of transfers into a failed BAA that are being used to clear their capacity short position have no cost and then only have an incremental cost applied above that. Our thinking, at least at the ISO staff level, was that if a BAA has failed the RSE and you get the prices right and all of their internal resources have been dispatched to meet that shortfall, then the resulting transfers are what they need to actually cure their short position. So sorry, Ben, I interrupted.
No, that's quite right, Danny. It was good for you to clarify the philosophy. I was just going to point out there's a nuance in if you were to allow transfers below that cap, 100 megawatts in the case of the example of Roberts, that if you then go above the cap, the logic of the market software would be is that whatever the shadow price or the penalty would be on the transfers above the cap, that would also automatically be applied and appear in the prices for the transfers below 100 megawatt. The nuance is that you could do something in settlements to sort of there's a coupon for free. You get a refund for the first 100 megawatts. But as Danny just pointed out, that the ISO felt that in terms of a matter of philosophy, that coupon shouldn't be applied any further, and that's a fundamental issue. And as Jim pointed out, that there might be some unintended consequences or some odd things that happen if such a system was implemented that at least I don't fully understand. I think need to be looked at some more in terms of pursuing such an alternative of retaining a cap and applying a penalty only to increments above that. The bottom line being this is not quite ready for prime time in its present form. And so we agree with the ISO about the deferral of this.
Right. I would say your reaction of is a good example of why deferring is a good idea. I just want to add a couple more things on top of that, which are just that I think there's a mechanical issue having to do with how the cap is set that's really problematic and would become worse if we had the penalty sort of kick in only after that cap. So if we were going to have like a free band of imports before the penalty kicks in, we would have to come up with some way of setting that exogenously, not in terms of something that's coming out of this multi-interval optimization. And then there's sort of more of a value or philosophical debate over whether, a receiving BAA that has failed the RSE deserves to have a free band, and how much of one. I think if it's associated with the risk of a false failure, if you will, that's one argument, but I think it's a better argument. It's better dealt with by what we're sort of talking about, which is a false failure is basically going to happen when prices are really low. And so if the penalty is really low, then the consequences of a false failure are pretty minimal. But if prices are really high and there's a failure, then the types of arguments Danny was making is sort of that logic kicks in. What Danny wasn't talking about is when there's a failure and prices are only $50, then you don't want a BAA to exhaust all its resources before trade happens, because that's just kind of inefficient.
Well, I would say under the current mechanism, when there is that cap, and we can put the cap at an import or an export level, and it can still be in the same type of situation. Because you can have varying renewable resources that are dropping out, you can have varying loads that are increasing, and those import or export levels can really be based upon deviations, renewables, and loads. And so under the current situation, if that cap level is set, there is a hierarchy of what happens. You may not have any type of price increase. You may just be status quo because that uncertainty does not show up. You may start dipping into your uncertainty in those certain circumstances because you are starting to show that you are getting close to being short. And then there's the point of exhaustion and use of ABC. So that's the current situation in the status quo, but it makes little sense to me in regards to now all of those transfers that you have are priced at a high value, even though you may not have that uncertainty show up in regards to loads or flex ramp. So that hierarchy that existed before, and then using that pricing for all those transfers that were imports at that current example, seems to be taking away that hierarchy and that market mechanism that occurs. Because when you have a flex ramp failure, there's not certainty that you are going to go short. You still are dependent upon your system to now balance to your load.
Well, just a second, I'm trying to understand that before you go on. If you fail, but you've got plenty of resources and there's no large uncertainty deviation, then you wouldn't need the transfers and there wouldn't be a penalty, right?
You're capped at that transfer. So in the 100 megawatts, say you only use 90 megawatts of it.
Well, but you'd still be taking transfers. You're still talking about when you need the EIM transfers. You're just saying, you might not need more than the amount you get for free. And, that is an option.
That could be based upon the economics of the previous hour, which those economics and the participating based upon the load and where your renewables could be, values that are not related to the economics, really just based upon what's happening on your system, could go into an import situation. For example, the market dispatched our resource to a lower configuration in MSG. There's still plenty of upward capability, but for that circumstances, now my my load increased and my renewables increased in the previous hour, so I'm importing. I still have plenty of upper headroom. And this kind of goes into the fact that what you're talking about, that failures occur most often not in scarce or summer conditions or high load conditions. They're most often occurring in situations where resources are on outage. You're trying to manage your fleet when there are low loads, lots of contractual imports or exports, and dealing with small participating quantities when you still have large load changes, large renewable changes. These are all the situations that you're trying to manage. And just to kind of go back, but you can have imports and economics can determine that situation. It's not a poor situation for you to have imports. You can still have plenty of economic or plenty of upward capability, but the problem is the market is making that determined, and it's not really a problem. That's part of the market. It's part of the opportunity cost of the market. So having a 70 megawatt import prior doesn't mean that I'm leaning on the system. That just shows that is the condition that the Western energy imbalance market put me into. So if I only use 90 of that 100 megawatts that I was capped at, that's just fine. We didn't have uncertainty. We used our entire system internal to our internal generation, and what we had set up in the day had to get to that situation. We measured uncertainty. We may have failed by maybe a projected load change that didn't occur or a projected renewable change that didn't occur, but to put $1,000 penalty on that when you're trying to opt into a situation where you may go beyond that level, that all that uncertainty shows up and all the bilaterals have dried up, seems to be in the wrong direction. And in the policy, it has always been emphasized as incremental on top of the failure. So I was very shocked to see that it was in regards to the total transfer quantity. And I'll jump off my soapbox.
Okay. All right. Well, thanks for that comment, Robert. This was an important discussion. Scott or Jim, any further response?
Oh, I'll just now. I think there's another person in the queue, or maybe not.
Yes, there is.
We do have one more caller in the queue. Caller, you are now unmuted. Please go ahead.
Hi, this is Alan Meck, SDG&E. I want to echo everything that Frank just said from NVE. I agree. I do not understand the philosophy behind you are paying for this incremental energy to pass the RSE, but then charging that cost to the entirety of the other 100 megawatts. If you fail by one and you needed 101 total, but you got 100 before for free, and now all of a sudden you're charging the entire 101 megawatts this penalty price, that doesn't make sense to me.
Well, I think that that view is conflating this idea of the severity of the RSC failure. So like something like the idea of I failed by 1 megawatt. And I can sympathize with the sort of like a failure of 1 megawatt shouldn't be that maybe as severe as a failure of 500 or 1,000 megawatts. But the idea that whatever I was importing in a previous hour is linked to the size of my failure in this interval, that's kind of where there's a disconnect there.
This is Scott. I want to remind you what Jim was saying at the beginning. We really didn't understand how much of a look ahead there was in the CAISO failure, and that the RSC failure was being applied prior to the HASP and was going into the HASP results. And Jim talked about the fact that potentially the EIM transfers are being goosed up in anticipation of failure, so that it tends to eliminate the consequences of failure a lot of the times, because in fact the cap has been increased so that you won't bind, and that's a problem. But we understand also that this discontinuous in the penalties is a strong reason not to choose this option, and it seems like there's some significant changes that are required to deal with this perfectly. But the basic approach of setting much lower penalties when there's lower negative prices will diminish a lot of the concerns during hours that there's not scarcity.
Yeah, I mean, it's worth asking the question whether, basically whether the consequences of RSC failure are meant to incentivize BAAs to not fail the RSC, which I think that was supposed to be part of it. And if it's just that, well, I can kind of get whatever I was getting last time I passed, and that's pretty good too, that's a pretty weak incentive. Now, maybe, the costs of failing just aren't a big deal either. I guess people could take that view, but it seems like when this whole idea was developed, BAAs thought it was a significant need to try to have some kind of guard against the resources kind of being exported out to a region that just doesn't have enough of its own, to the point that it might make a BAA potentially less reliable on its own.
Right, to solve the leaning problem.
Yeah, I try to avoid the word leaning, but it keeps getting back in because everybody has a different definition of it. But yes,
Hey,
right.
Jim.
Mm-hmm.
Hey, Jim. This is Brad Cooper, ISO. The last couple commenters, are objecting to the penalty being applied to all imbalanced energy, where in our mind, that was a core concept in that we would put in this hurdle rate and then dispatch all resources before, to minimize transfers and only dispatch transfers if they're really needed. So I know you guys don't object to our high penalty all the time, and we got that point, but can you guys comment on the merits of applying it to all imbalanced energy versus just the amount of incremental transfers?
I'm sorry, Brad, by you guys, do you mean the committee or the folks on the line?
Yeah, no, the committee. The committee. Yeah,
Okay.
yeah.
Let's narrow that down.
I thought we were on solid ground with our concept of applying it to all of balanced energy once we hit that price. But it sounds like people are disputing that. And I wondered if you guys could opine on that, because that's kind of a fundamental thing we're going to have to look at.
Yeah, I guess so. If you think about, and I think this is the paradigm you guys have had in mind all along, that the system is really tight, and RSC failure is reflecting the fact that there's a BAA that just cannot meet its expected needs, and that everybody else is getting close to exhausting their resources as well. then yeah, under those circumstances, every megawatt that's flowing out of the region that's close to short to the region that's already short does increase the risks to some degree to the exporting region that started out with enough but might be getting close to the edge as it exports more and more. Now, is it linear? I'm sure you could come up with a really complex sort of sense of with every megawatt I export, I'm increasing my loss of load probability by some, amount. And so there probably is some nonlinear relationship. But I think the idea to avoid that level of complexity that we kind of keep emphasizing is if we know that everybody's getting close to short, then yes, I think it's legitimate to try to say that every export into a BA that's already short is increasing the risks for everyone to some extent. But if we're in all those other periods where we're not really at risk of regional scarcity, then the implied increase of loss of load probability, or wherever you want to call it, from some of those flows would be more modest. Or yeah, and then you're kind of more into what's the right deterrence kind of incentive there. So that said, I don't think I don't see a strong economic logic in favor of giving, a certain band of unpenalized imports into a failed BAA. But at the same vein, and I haven't thought this through, I don't know if there's a strong economic logic against it either. It's kind of more of a value judgment of, what do they deserve? Having failed, what do we think is appropriate for a BAA who has failed? And so if there is a way to come up with a band that is truly exogenous, I don't think it's the worst thing in the world. I think it is kind of the question of where the incentives, how strong an incentive you want to provide to try to, have folks pass the RSE. And I think that incentive should be stronger when failing the RSE is actually going to have these negative spillover effects on people. That's a long way of saying I don't know. I think if you could come up with a way of solving this endogeneity problem, then it's probably something that wouldn't be economically terrible, or reliability consequences would be a little tougher. It depends on how close we are to that.
So just speaking for myself, I think the endogeneity issue is the one that I'm most concerned with. And if there is a dead band, that's, as Jim also suggests, that's less consequence. Alan, I wanted to ask, just to make sure I understand what the concern is. So if there was a 100 megawatt dead band, wherever that comes from, are you concerned with the fact that if there's 99 megawatts of transfer, that would be charged whatever the penalty is? Is that that seems like it's taking something away and is perhaps overly punitive of a change? Or are you also concerned with if it turned out it was 101, so that 101st megawatt is worth more than $1,000? That would then set basically through shadow prices that would apply that $1,000 penalty to all 101. Is that something that also bothers you, or is it just the first case that if it turned out you only need 99, you would still be penalized?
I think that my concern is that you're mixing science and religion. You're mixing two things that just don't mix, right? You're goosing congestion prices to solve an RSE failure problem, when really the way that I think that it should be looked at is up to 100 megawatts, you were fine. At 101 megawatts, then you fail the RSE. That 1 megawatt you need to go and buy from someone to get into your BAA to pass the RSE. That's outside of and separate from your LMP. It's separate from your pricing within your BAA.
So right now, with that, if that 100 megawatts is a hard cap, and that 101st one is really worth 1,000 or whatever, the shadow price would be at least you'd bring in the 100, and the shadow price would be at least 1,000. So in terms of what you would be paying through shadow prices, that actually doesn't change. You're actually better off in that the shadow price might fall if you buy a bit at whatever that penalty price is.
How do we know that the shadow price is 1,000 though? What if the energy trading over in a neighboring BAA is, $200 a megawatt hour?
So that would then show up as through the market software, is that if that is actually the marginal cost, it would then show up as a $200 shadow price on that 100 megawatts. It would hit the cap. You'd have a shadow price of 200 on the import transfer. That's what you have right now. And then if you had a penalty over 200 for anything over that, well, the shadow price won't go up because you won't do that transfer. The market software won't do that. So you're not any worse off. You're still paying that $200 now, and you would pay that $200 if they had a high penalty implemented for anything over that cap.
Isn't the proposal that post this enhancement you would pay $1,200, not $200?
So the proposal is now that 1,000. The proposal now 1,000 would be applied to any transfer, and that it would be 1,200 or something else. I was articulating an alternative that I think I'm hearing you suggesting. I'm not sure.
There's two alternatives that we describe in the opinion that Ben is kind of describing. One is that you get a certain amount for free no matter what, no penalty, I should say. You're paying market price. There's no penalty on the certain amount, and then the penalty kicks in after that amount, and every megawatt after that is charged that amount. That's one option. Another option would be you get a certain amount for free unless you go beyond your threshold of what that certain amount is. And once you start importing more than that certain threshold, then the penalty prices would apply to everything, not just the increment above that threshold. And I think what you guys, I believe, Robert and you have been sort of advocating, or maybe you believe that was the proposal, is that that threshold should be the same threshold we use today for the cap. And one of the points we want to make is that that's really problematic because that threshold itself is solved for as part of the market solution, and which is problematic today and would become really problematic if there's a $1,000 sort of kicker on top of that as well. But I think the idea of having some kind of band that is, if it's not part of the market solution, is something that could be discussed. And again, it's sort of part of like an incentive for passing the RSC versus what we think of as fair. How much imports do people think is fair they should have before a penalty kicks in?
Something as simple as a percentage of load or something. But I can imagine the discussion of that will be a little fraught. But
right. We were supposed to end at 3, right? Or what was this scheduled for?
3.
That's correct.
Yeah. And we've got Kathleen Roberts back in, Bonnie Blair's in the queue, so maybe we can do a speed round.
Yeah, I think that's a good idea since folks have been waiting, but let's not go too far over time. So the next person is Kathleen.
I'll be really quick. Kathleen Colbert from Vistra. I just jumped in the queue because I thought the discussion was helpful. What something Brad said, I just wanted to share with you all that I've had a lot of confidence in this effort throughout it, but at some point kind of stopped paying close attention because it seemed like the design was going really well. My understanding at the time, my understanding the whole time has been that the penalty would apply only above the cap that we have today as an out-of-market settlement, and I will say I need to clearly get re-educated up on what has changed between then and now, but the principle, because you said, Ray, what's the economic principle? Well, the economic principle that we got comfortable with is kind of a do no harm. the market rules as they exist today allow for net imports into an area when they fail up to a cap. And the issue that was raised is that in certain instances that may harm reliability, such that we have a societal view that it is better for the entire system and society to allow for that additional 1 megawatt to go into that area at a penalty price. But I had not been thinking of, under the do no harm principle, of penalizing what would have been let through absent of that. We're trying to increase overall utility, not trade-offs of utility into those areas. So that's the economic view that we had that got us comfortable with it, and I'll just leave it at that. Thank you.
And I understand that, and I think that's the problem we've got, Kathleen, that there's a trade, this discontinuity. But on the other hand, we got to remember it's not always 100 megawatts or 10 megawatts. Suppose it's 1,500 megawatts. And suppose it completely drains all the unloaded capacity in the rest of the EIM, so that all the people that did bring the amount of resources they're supposed to the market, there's no unloaded capacity for them to balance when they have the uncertainty. So, I mean, there is this unlimited leaning that's created by the software is a problem, as Ben and Jim were pointing out. And it's one thing to frame it in terms of an extra 10 or 20 megawatts somewhere or 1 megawatt, but it's not that innocent if it's 300 or 500 or 1,000 or 1,500 megawatts. So that's I understand that we're in a situation where the answers aren't simple.
Yeah, and
well, and that's.
Sorry, go ahead.
No, I can say that's really fair. Another thing that I understood would happen, and it would help if the Kaisa would clarify, is that these energy emergency assistance and incremental transfers would only occur where there was sufficient supply to support it across the entire system. So that is another embedded assumption that we understood.
Well, that's part of what we're talking about. When the price is low, allowing these transfers to occur makes a lot of sense. That's what Jim was talking about at the very beginning. But I think we think that's a given, that there ought to be no penalty or no significant penalty when prices are low. But now I think we've focused in on, suppose things are really tight. At what price do we drain the last 100 megawatts of unloaded capacity in the EIM?
Yeah, and that's where the $1,000 penalty comes from, is, as Danny was saying, that the spirit is you want to ensure that the BAA that is short is deploying everything it has before you would start taking more imports from other places. And I believe your question was, well, what if there aren't other resources to back those imports? Well, then I think even at the penalty price, there just wouldn't be sellers. I guess you could still have a problem where you exhaust flexible capacity when you're selling $2,000 power into the short BAA, but that wouldn't be that power wouldn't be bought lightly.
Well, that's all fair, and I'll just leave you guys with one last, since Brad got you guys. I'll leave the esteemed Market Surveillance Committee with one last thought, which is that another part of how we got comfortable with it was that I thought it was the first phase would not be impacting price formation inside the market. This would all be done in a settlement charge, and we could look at the market results and we could evaluate that before we designed the impact and brought it into the market, which is always something we think should happen. We want that for price formation, but we thought it was really complex and that we needed some experience with this. And so we got comfortable with it. We could get experience. We could see how it worked in the market, and then we could really delve into what the right pricing and settlement design should be for the more durable. But I understood this to be a phased approach to address some of these concerns.
Always good to be able to test things, and I think along the lines also of the do no harm spirit, it becomes more complicated when you're in a situation where there might already be harm being done. And so if the current situation is problematic, then, sort of trying to only move in a direction if you can ensure certain things get better could paralyze things and keep you in in a problematic place if you're already if you already have some problems.
Okay, so thank you, Kathleen. I think I'd like to go to Bonnie, who hasn't had a chance to talk yet. Silas, could you unmute Bonnie Blair?
Absolutely. Bonnie, you are now unmuted. You can go ahead.
Hi, this is Bonnie Blair. I work with the Six Cities group. I'd like to make 2 points about the impact of what I understood the CAISO proposal to mean, and I'm very glad to hear about, deferring finalization and considering the alternatives. I think the notion of tiered consequences is very helpful. But 2 things. One is there have been suggestions that the penalty price would apply to all imports once it kicked in. My understanding, and I believe this is consistent with what Brad said, is it wouldn't just apply to all imports. It would apply to all imbalance energy in the BAA that was receiving the assistance. So that, for example, all of the internal resources in that BAA would be paid the penalty price plus the whatever the actual cost of the energy. So if the energy cost was $200 from the BAA that's providing the assistance, the imbalance energy price in the receiving BAA would become $1,200, and it would apply not just to EIM imports, but to all imbalance energy in that BAA, meaning being paid to all internal resources. That's point 1. And so that was part of the design that we were very concerned with. And now I've lost my second point. There was a second point that the question about draining the resources of the assisting BAAs. My understanding is that the CAISO has a constraint that already exists that's built into the optimization that would prevent an EIM exports that would have the effect of effectively of triggering the power balance constraint in the assisting BAA. And I see Danny nodding, and so I don't think there's a concern about that, assuming that export constraint still exists and would do what it's supposed to do.
Bonnie, this is Scott. I disagree with that because, as we pointed out in the opinion, that exporting BAA was counting on the uncertainty requirement, was counting on the diversity requirement to be available, and it doesn't necessarily have enough capacity to survive, an unexpected deviation of its intermittent resources. And if the BAA with no resources has drained all the diversity energy out of the rest of the EIM, then everybody's at risk that if they have that bad outcome, they're going to have to shed load, regardless of this exporting thing. And it basically tells BAAs you can't count on the diversity benefit. So, I think that goes to just unwinding the whole premise of the EIM if you can't count on the diversity benefit.
Yeah, I see that point, and I guess it may be that the question becomes, maybe I didn't fully appreciate exactly how the export constraint works, or whether it kicks in soon enough. And I don't know whether it could be tweaked to kick in, at the point when the diversity benefits are starting to be exhausted or drained.
Right. Really, the RSC was meant to be that limit, and it's probably not doing it as well as we'd hoped.
I was going to say, bringing this back full circle, I've always seen the issue being that the diversity in the FlexiRamp gets drained and repackaged as LPTs that then get counted in CAISO's obligation, and then maybe even more LPTs get cleared from the CAISO BAA, which are then shown on base schedules, which may or may not actually be feasible if the uncertainty materializes. I think it does feed back into that discussion.
The more we talk about this, the more, issues there are. It's troubling. And that may be why we got so much load conformance, is to try to keep the everything from being drained by all these HASP exports and all this other stuff.
Bonnie, regarding your first point, I think it's similar to what Kathleen perhaps was suggesting, that that there was an anticipation that this would be somehow out of market. But in fact, the proposal and the logic of the market software is that if that penalty, if it turns out that there are transfers that are paying that penalty, then that shadow price will spill over. It will be part of the EIM price for everything in that BAA. It was not proposed to be something that was somehow, there'd be something else in the objective function and the transfers would occur and there'd be some after the fact penalty applied. That's definitely not the proposal. So I think it's another reason to have further discussion to make sure that there's understanding of this and what the implications might be.
Just to clarify, it only applies to deviations from day-ahead market schedules. And it applies to all those deviations, and that means it includes the real-time exports. It applies to the generator that tripped and caused the $2,000, the failure. It applies to the virtual supplier. It applies to the specific load serving entity that underbid in the day-ahead market. So, it does have some targeting properties to those who are contributing to the problem.
And the imbalance energy price only includes that EIM penalty if there are EIM imports. So the system has to really need really expensive imports before you get to that, in which case the system is getting really close to short, and so imbalance energy is pretty precious.
But it could happen in one of these many instances when there's just all kinds of energy in the outside,
Well, that's exactly why.
Market.
Right. That's exactly why we don't want the $1,000 penalty when there isn't really a regional problem. But again, I think my sense is it's less likely that we would see prices go up with the penalty and more like we'd just see no EIM imports. Now, CAISO, it's a little harder to know, I think, but.
Tim, that's an important point, is that this rise in the EIM price will occur with the present cap as well. If that additional 1 megawatt of transfer is really worth that much, then the shadow price under the present system, under the present cap, will be at least $1,000, and the EIM price will have gone up anyway. So that's actually not a change.
Yeah, that's an important point, Ben, that I want to re-echo. Right now, if a BAA's transfers are fixed and they go short, their PVC would get relaxed. The prices for the entire BAA go to $1,000. So this isn't that crazy of a jump. Like, by trying to price the transfer cost at that level, we were trying to make sure there was some consequence for if external prices are really, really high, that there's not just a $25 or a $50 transfer cost for accessing that energy. There needed to be a bigger price differential that kind of corresponded to a BAA was actually short. But to your point, right now, if a BAA goes short under the current failure consequences, their prices go to $1,000.
Mm-hmm. Bonnie, thank you. Is there anything you want to add to that before we go to Robert, who's I think the last person in queue? Okay, thank you, Bonnie. Robert?
Thank you. I'm glad you threw me in last. I have several notes on it, but I'm just going to highlight a couple. This discussion in regards to increased transfers prior to test results. Just a quick history on this. The test results, or the cap that used to be implemented, occurred in the interval 4 of the previous hour. It was modified 4 to 5 years back that it was calculated based upon the most recent RDP solution, based upon where the interval failure was. And that was done so that the increased loads over could represent the transfer in a past time frame within your current hour. And so those increased transfers that might occur will take into consideration your economics, including your FRP, including your possible situations of power balance violations. So take, for example, if you did fail interval 4, interval 3, and didn't have a large shortage in interval 4, because that interval 4 is going to be solving, taking into consideration your uncertainty, so on and so forth, it may not increase those transfers in that previous hour. It may be under only certain circumstances. So I would like to recommend that don't jump to conclusions that this is occurring frequently. I would wait for the data in regards to that. Second of all, in regards to the leaning on other areas, in our initial proposal, we had suggested using the resource sufficiency results to measure if there is available emergency energy capacity. And what I mean by that is if you fail, but every other area has a surplus of 200 to 300 megawatts, then there could be reasonable quantities to provide that emergency energy. But in the scarcity situation where you fail the test and there's very limited quantities of capacity in regards to the test, that could be a very useful measure in regards to determining how much emergency energy could be provided to that region. And we came up with some pro rata values, and you could also use that in regards to how you determine your settlement. So I'd just like to point back to that initial proposal rather than trying to do some complicated pricing mechanism when you have some simple information that tells you how much extra energy every region has. And thank you for hearing me today.
Okay, thank you, Robert. So we're now almost at an hour and a half, and so I would like to conclude soon, but give Jim and Scott a last opportunity to comment if you'd like.
No.
I'll just add a couple things that, a simple test is nice, but I think a prior RTPD run would be better because we know that the RSC results are kind of doubtful because they include HASP exports that are supported by EIM transfers. So we're eating up our surplus, and we also know that we've got the no uncertainty component in the current RSC capacity. So I think looking at a prior RTPD interval and saying what is the price is more reliable of what the situation is, whether it's slack or not, than dealing with these RSC calculations, which the more we heard about it, the less confident I became that they're going to show tightness when we're tight.
Okay, thank you, Scott, and thank you, Jim, for leading the discussion and the summary. So at this point, I'd like to conclude. We're not going to have a vote at this point. Instead, I'm sure we'll be revisiting these issues with stakeholders and in the next month or so, and in preparation for whatever winds up being submitted, commenting on whatever winds up being submitted the joint board in December. Let me just check, Danny, is there anything else that you'd like to add about the schedule or anything else?
No, thank you.
Okay, all right. Well, thank you, everybody. Appreciate you sticking through the conversation, all 50 of you out there in MSC land, and we'll be looking forward to talking to you further about this in the near future. And we have an MSC meeting scheduled this Friday, do we not, Shami?
Yes, that is correct. 9 a.m. to 4 p.m.
Okay, looking forward to talking to all of you then. Thanks very much, and Silas, we can conclude the call now.
Thank you very much. That concludes our conference. You may now disconnect.